Welcome to USAWatchdog.com. With us once again, Dr. Jim Willie. He has an earned PhD in statistics. He is the editor of the Hat Trick Letter, very popular publication, and you can find it on goldenjackass.com. Dr. Willie, thanks for joining us today.
Oh, pleasure to be back, Greg.
Well, I've got to talk to you about all this going on overseas. You don't see a lot of it here. And what's going on overseas is an exit strategy. It's something you've been talking about. Can you tell us what's going on with how the foreigners are looking at all this dollar creation and then all this QE and what their reaction is to it? Apparently, according to you and your research, they are going to exit the U.S. dollar.
Well, it started a few years ago with the Lehman Brothers breakdown. That was the signal to the foreigners that the U.S. banking system was dead. Not in trouble, but dead, as in D-E-D, dead. The second thing they noticed was, gee, this quantitative easing, the bond monetization, this is unilateral monetary policy that's exercised by the United States without any input by China or Russia or Brazil or Japan or any of the big bondholders. So these bondholders are taking losses on their reserve holdings, and they figure, well, we got to do something about this. Then the third event was the Iran sanctions came on, where all kinds of bank regulation obstacles came about using SWIFT codes in banks as a weapon. What it did was it galvanized all these different programs and policies by the United States alone. You know, we like to say, oh, we have full spectrum dominance, we can do whatever we wish, the world can go to hell. It's not that simple. The world doesn't go to hell. The world makes a reaction. And what they've done is they've created, slowly but surely, a U.S. dollar alternative for trade. Now, the dollar is the reserve currency in banks, and I guarantee you 95% of Americans have no concept of the dollar except as the currency for buying groceries, paying for your bills, paying the rent, or whatever, contract settlement in the United States. But since it's the global reserve currency, since the dollar is the trade settlement standard currency, it's in all kinds of international contracts. The United States, therefore, cannot change the rules for its usage internationally. The United States has lost control of its dollar outside the borders, and now, through inflation, has lost control of the dollar inside its borders, and the dollar will turn out to be a noose around the United States' neck and result in systemic failure. What the foreigners have done is they've created a Eurasian trade zone. It's basically, I call it the axis, the corridor between Russia and China. They've filled out all kinds of skeleton and circulatory system, as I like to call it, with pipelines for oil and gas. It's going to be Russian supply going to China, and it's going to be Chinese payment in treasury bonds, which the Russians will use to dump on London banks in a discharge as they get rid of the British petroleum interest in BPTBK. It's a five-letter acronym for a very large oil company in Russia. The biggest oil company in the world now is Rosneft. It's twice as big as ExxonMobil. Go figure. But what these Eastern nations have done is created a trade zone. It's going to be financed by treasury bonds, and the flow of energy and oil and gas will be paid for by China in treasury bonds. All these treasury bonds will go back to the United States, where they can choke the U.S. bankers and choke the London bankers. The U.S. and London cannot refuse them because it's sort of their native currency. And then the next thing these Eastern nations have done is to create what they call the BRICS Development Fund. And for those that aren't familiar with BRICS, it's a term that Goldman Sachs economist created 3 or 4 years ago. It's Brazil, Russia, India, China, and South Africa. And now there are 2 more I nations, Iran and Indonesia. So it's really not BRICS, it's BRICS. That's my little funny joke. But this development fund has gotten, I think, very incorrect Western press coverage. They called it a failure because they couldn't agree on funding it. Well, they did agree on funding it. They made pledges for $100 billion, but initial seeded commitments of $50 billion. It's going to be in treasury bonds. Now, the Western press, they prefer to describe it as a project development fund. and they mentioned an African railroad for Tanzania. This is a lot more than construction projects in Africa. They call it the BRICS Development Fund because they didn't want to call it the Gold Trade Central Bank. Now, if they'd called it the Gold Trade Central Bank, there might have been a terrorist incident at the conference. And gosh, I guess Islamic terrorists would have shown up. No, out of Langley, Virginia, by the way. No. So, in the next several months, you're going to see more news about the seeding of the BRICS Development Fund. And eventually, I have been assured by my source of information, and I don't know the degree of involvement, but I believe that he's involved to some extent, or he knows people who are. They're going to start converting the BRICS Development Fund, aka Gold Trade Central Bank. They're going to start converting the treasury bonds into gold bars. The gold bars will be a gold and silver core in the central bank for trade that will be used as collateral for different countries that want to secure letters of credit that will be known as gold trade notes. So we're not going to have dollar-based settlement anymore among these Eastern nations. And, you know, if you think that this Eurasian trade zone is just like a bucket over there in the corner, no. It's 2/3 of the global economy and 3/4 of the globe's people. And the United States is not in it. The Obama administration, in its infinite stupidity, tried to push the Trans-Pacific Partnership, and the requirement to Japan and Korea and the Pacific Rim, including Taiwan, was join our trade zone. We're going to exclude China. If you exclude China, you can be part of this. What kind of stupidity is running in Washington?
So, Jim, what happens to the man on the street when they start selling these treasury bonds that, London and the U.S. cannot, refuse? What happens to the guy in, St. Louis, Missouri, or Portland, Oregon? And also, what's the price of gold in this new development fund and the price of silver? Have they agreed on that yet?
I'd like to start with the price of gold because that's very near and dear to my heart. These Eastern nations, they're holding a lot of gold reserves. And also, by the way, they lie about their official gold reserves. Russia holds at least 5 times as much gold as they announce, which means almost as much as Fort Knox at its height. The Chinese have at least 5 times as much gold as they admit. They're buying tremendous amounts of gold off the regular market, like with the Congo. Okay, so these Eastern nations are really angry because they've seen for years now the Federal Reserve printing money, damaging their treasury bonds, and doing more than that. They're making them with lost integrity. So they're going ahead now, and what they've done is they're agreed upon a price that they want to see gold and silver at. Gold and silver will be the core. Those are the monetary metals. It's already been agreed upon. They're waiting for the crisis to result in a climax of collapse, which is coming. It's probably going to come, by the way, in Italy, not Cyprus. Italy will be the tipping point. But these Eastern nations are angry and motivated, and they see the naked shorting of the gold and silver contracts. They see that the price is not correct. They see also that there are enormous short positions held by the big 4 banks in the United States plus London. They therefore understand with the clarity of a midday sun that the price of gold and silver is much higher than what is posted in the COMEX, which is corrupt and going to shut down in a matter of months, maybe a year or so. Who knows? They've agreed upon, therefore, a $7,000 or a $7,500 gold price. They've agreed on $150, $200, or $250 silver price. These are per ounce. These are 5 to 10 times, well, not 10, but 5 times greater for gold and multiples higher, 8 times larger for silver, 7 and 8 times larger for silver. These are agreed upon. And when this comes about, you're going to see London and New York, they won't have any gold. That's what third world nations do. They won't have any gold. Last spring, in March, April, May, June, and July, my source was very clear because he was part of some of the transactions. They drained for Chinese buyers. They call them Eastern buyers, but they're predominantly Chinese. There might be some Singapore and Taiwan and Japanese, but it's primarily Chinese buyers. They drained 6,000 metric tons of London gold. It was done off market. It was done with pressure. It was done on leveraged trades. And I tried to get information out of my source. I said, well, wait a minute. Why is it off market? Well, Jim, these are special kind of euro leveraged futures contracts. And I said, you mean like French and Spanish, Italian, Portuguese, and Greek bonds? He said, yes. I said, well, why is it off market? And is that the source of the leverage? Why is it off market? And finally, he wouldn't tell me. So a month later, I said, I think I figured out why they'd done it off market. And it's for the simple reason that the collateral used for the trades by the London banks was improperly derived from allocated gold accounts like for the government of Germany. And since the gold was gone, these Eastern entities said, look, you've used our collateral. We're going to call you. We're going to call you on these debts. We're going to give you a margin call on this because you have insufficient margin. You can't produce and prove that the margin exists and it was ours to begin with. That's why it was all done privately. And these were at the point of a gun. If they hadn't settled and traded and given back the 6,000 metric tons, I believe certain bankers in London would have been killed. All right, so they've agreed on $7,000 gold and $150 to $250 for silver. Now, for the man on the street in the United States, he's not going to see, oh, gee, they got some real big treasury bonds the Russians and Chinese are dumping. No, because the Federal Reserve is going to amplify and double up the amount that they buy. That's what they do. They're inflation machines. They call it financial engineering. Now you're seeing the financial engineering just run the truck over the cliff. They're going to double it. You got a $3 trillion balance sheet for the Fed. It was $1 trillion about 4 years ago. Now it's 3. Expect it to double. I mean, expect pressures for the Federal Reserve to resign because they're going to go broke. These are private-owned banks called the Federal Reserve. New York Bank is the primary one. The man on the street, to answer your question more directly, is going to notice, hey, wait a minute, I don't understand. How come half the gas stations don't have any gasoline? Hey, wait a minute, I don't understand. I don't shop at Walmart, but I hear from my friends, my poorer friends, that half the shelves are empty. And Walmart already now has a problem with some empty shelves, not the majority, but some empty shelves, because their lower sales has now hit them, because they've got sort of a fractional banking system working for their inventory. They use cash inflow to cover their accounts receivables. Now their inflow is worse, so they're having a tenfold effect on their inventory replenishment. The man on the street's going to notice, hey, wait a minute, I don't understand. I need to get a CD for my daughter. She's going to college, but I can't find any. How come Best Buy doesn't have any? It's because these foreign suppliers are going to tell the United States, we don't want your stinking dollars. We don't want them stinking up our banks and killing our banks. So therefore, the United States is going to be in a real big bind. They're going to have trouble supplying the economy at a time when the foreign suppliers don't want the dollars. So the pressure is going to come, and they've got an enormous task. Right now, the Department of Treasury is working on, but they have no solution. The task is to split the dollar. One to be foreign dollars, and the second to be, they've given it a name. I don't know if it's going to stick, but they've given it a name of Treasury dollars. I don't know if it's going to stick with Treasury dollars or whether they're going to have to do something more radical called the Amero. I don't know. But I've heard Treasury dollars, and I've seen copies a year or two ago of printed Treasury dollars. They're filling warehouses with them to supply the economy because these dollars are not going to be the same ones sitting in Swiss banks, Panama banks, and Hong Kong banks. The United States has the task of splitting the dollar into a domestic one and a foreign one so they can take the domestic one and devaluate it by 30 to 50, maybe 60%.
We're
if it's 50%, all in, well, that will be your inflation from the imported side. But the United States makes plenty of soybean. They produce some metals. They produce some gas, although the Bakken Reserve is a grand Ponzi scheme. They do produce a tremendous amount of agricultural products, but the United States is actually a net importer now of food, very slight importer of food. The United States is going to be okay on the domestic side for supply, but they're going to have to mix in the price structure, all this doubling of costs from the imports. The big major blow, Greg, is going to be when the Saudis say, we don't require the dollar for oil from you, Japan, and you, Korea, and you, France, and you, Germany. We don't require it, but we don't really want it. We'll accept British pounds, Swiss francs. We'll accept euros, but we really don't want the euro either. We don't really want the yen either, because the yen is being pushed down in value by their own government and central bank. In fact, what we really would like, says the Saudi kings, is gold. Because you central banks are not killing that currency. You're sitting on it, but when you run out, price would be quite different. It'd be double, triple, 5 times as much. Because the Saudis understand what's going on with Russia and China. They're privy to the developments of Eurasia. They're privy to the developments of the BRIC Development Fund. And they've been already promised 2 years ago. I think it was actually 3 years ago. This happened on an Easter weekend. I don't know if I ever mentioned this, but I got what was called an Easter egg. That was the title of it. On Easter Sunday, it was a meeting that took place in not Dubai, what's the other one? Abu Dhabi in UAE, with 200 different Arab billionaire sheikhs. And they had a conference. It was Arab only. There were no white faces. There were no British. There were no German. There were no anybody. There were no Chinese there. It was an agreement, a conference to come up with an agreement. And the agreement was made. The Persian Gulf nations accepted the Chinese offer for protection. They accepted the offer for arms supply, missiles, and whatever from Russia. So what they were doing is getting ready to phase out the U.S. military protection that is the other side of the petrodollar. So when the Saudis finally come up and say, we really don't want your dollars, but we'll take them. We prefer other currencies. We'll accept other currencies, but we'd really prefer gold. That's when you see the dollar dead, and that's when you see, I believe, U.S. government debt default.
What will happen?
We're not going to get
What will happen here in the United States? You're not talking about inflation. You're talking about implosion.
Yes, we talked about that before, yes. I don't believe we're going to get standard garden variety powerful inflation, price inflation. I believe instead what we're going to get is large, widespread cutoff of supply chains. And notice that the United States is also suffering from things like drought, Ponzi in the Bakken Dakota region. That's going to come to an end. It's not the independence avenue for the United States. It's the latest disgusting, criminal-driven Ponzi by the administration with Halliburton at the back seat. I don't want to get into the Gulf of Mexico, but just for Bakken, for your listeners, they made an agreement to cut off that Keystone oil pipeline, which helped Warren Buffett and the Burlington Railroad, because now they've got something like a 5-fold increase in cargo that's going along those tracks. But more than that, it helped Halliburton in their monopoly of the highly toxic chemicals used for fracking the shale to produce and release the gas. So it's very temporary. You get depletion after a couple months, and then you get a downhill. So what they're doing is they're making a lot of new wells that deplete almost immediately, like in a month or two. And Halliburton is making out like bandits with the monopoly on the fracking chemicals, which are responsible, in at least Pennsylvania, for polluting the groundwater. Farms all across Pennsylvania are complaining about it because they're doing fracking in western Pennsylvania, where I came from. Now, the man on the street's going to notice shortage. The man on the street, I've been saying this for years. Price inflation is not going to be a real big issue in the United States because they're going to control price. What you're going to get is shortage.
Okay, we'll wrap up with one last question. A lot of people have been saying that they're going to come and take your money out of your bank account at some way, shape, or form. There'll be capital controls. They'll insure your money, but you won't be able to take it out. Anybody over the insurance, they'll take the money to recapitalize the banks. What's your read on a Cyprus-style bail-in here in the U.S.?
I found it quite interesting that after Cyprus took place, Ben Bernanke agreed that the U.S. private bank accounts were at risk of similar types of taxes on accounts and potentially confiscation. And he conditioned it on provided the U.S. dollar is rejected internationally. That's exactly what we're talking about here. I'm giving you the scenario for the dollar rejection, and Bernanke is telling you the consequence of that rejection. Now, something happened in 2005. It was called the Bankruptcy Reform Act, or something close to that. Most people focused on the fact that the Chapter 7, complete wipeout of debt, offset by whatever assets are brought to the table. The assets are put to the table, the debts are put on the table, you match them up, everything's, whatever, at 5 to 1, and the creditors get a little bit, 20 cents on the dollar, 5 to 1, and everybody goes away. The creditor's a little upset, and the debtor debt-free. Well, that's all gone as of 2005. That was the Bush Jr. administration. And what they did instead was they said, Chapter 13, the restructuring is the way we're going to go. And you cannot walk away from any tax. So some people maliciously called it, which I think was accurate, that it was a debt slave reform act because you couldn't walk away from your debt, nor could you walk away from your tax, but you could reduce the impact of your debt with a restructuring and a payment plan in the future. Now, that was the part I focused on, and I was very aware of that in 05 and 06. But what came to my attention in 2011 was that there was a second side to that Reform Act for bankruptcy. And it was the corporate bankruptcy reform portion. It was the financial firm bankruptcy reform portion. And what they said there, incredibly, was that the private accounts for clients were considered bank assets. So when you open say a $50,000 bank account with whatever bank, XYZ, what you're doing is donating your money to the bank. They call it an asset. They don't put it on liability at all. It's a bank asset. And they will permit you with interest-free withdrawals of that money you donated to them. In fact, they'll give you a little bit more than that. They might give you an extra 2% a year just for the favor of giving them your money. They did something else. It was nasty and I think is malicious to the point of exposing the fascist bankers. These are Nazis. I mean, let's quit poo-poo cooting around. These are Nazis. They have 10 to 12 different traits. This is just one of them. Aggressive war to steal central banks is one of their favorite pastimes. See Iraq, see Libya as references. The pernicious, malicious thing they did was they said, your private accounts will be subordinated as bank assets under the derivatives. So, all the different credit default swaps, interest rate derivatives, other exotic links that they have to keep the treasury bonds tied to the currency against the euro and against the British pound, all these different derivatives that are in the $700 trillion neighborhood are probably going to go bust someday. But your bank accounts and your stock accounts and your CDs and your mutual funds and your pension funds and your whatever funds under the financial firms are all subordinated to these derivatives. So that when you get a big event, let's just say, for instance, Citigroup goes under, you're going to see a replay of what happened with MF Global. 140,000 accounts for futures brokerage vanished. The press gave a false story that they got 60 cents on the dollar. I have a client who's part of a class action lawsuit. They've gotten zero. So the press report was a lie. The MF Global is your model. Now, I for a while thought, gee, why aren't they treating it like a brokerage firm where the private accounts are first? It's because the account holders donated their money to MF Global under CEO John Corzine. It was then considered a financial firm asset. It was not a private account anymore. They permitted the private account holders, who thought they were private account holders, they permitted them to use that money and to put risk by buying contracts and to benefit from those contracts. But unfortunately, since the firm went under, the derivatives imploded, taking down all the subordinated private accounts. That's what's coming to the United States. I got a different way of describing this in layman's terms. The monetary system of the United States has a debt foundation because the dollar is basically the flip side of a treasury bond. Therefore, when the write-down and the losses come from the debt write-down across the United States economy, you're going to see tremendous national wealth loss because the private accounts are really just bank assets.
So the best way to protect yourself is to buy gold and silver and own your house and artwork and gems and anything tangible that you can own and title.
Yeah, and stay out of debt when you're doing so, and best not to put it in a bank security, what do you call it, safety deposit box, because there's one precedent already, 3 weeks ago, in Cincinnati, Ohio, the Fifth Third Bank, or Fifth, I think it's the Fifth Third Bank, I get confused. Yeah. The Fifth Third Bank had the CIA come in and help themselves to 20 Krugerrand coins, 1-ounce coins, owned by some, I believe, a nitwit who put his gold coins in a safety deposit box, which is expressly forbidden by the Patriot Act, which I believe is the Nazi manifesto. So, buy your coins, buy your bars, open up a gold money account, and take your account and vault it outside the United States because they're going to try, I think, to confiscate. They're making it very difficult to sell gold coins now. In Houston, Texas, and other cities, you have to be photographed and ID'd and fingerprinted in order to sell. And they're trying to say it's to protect the market from counterfeit. No, it's to identify the owners and to discourage them from buying in the first place. There's a big paper trail for buying gold coins. It's a lot easier outside the United States, and that's one reason I left the United States, because I didn't want to be part of the implosion that we're describing here. There are going to be extraordinary events coming in the United States. Now, I got a number of poo-pooers. They say, oh, yeah, sure, Jim, and including family members. I mean, it's insane. I get far more respect from clients and hosts like you than I do my own family members. Well, let's face it. When I was a little kid, they saw me pooping my pants and, cleaning it in the bathroom. And they saw me, cutting the cheese, watching the Pittsburgh Pirate baseball game. And they saw me skin my knees and they saw me do stupid things. But my clients didn't see that.
Well, your family also probably saw you graduate with an earned PhD in statistics. And I got to cut it off here. Dr. Jim Willie, you are the editor of the Hat Trick Letter, and you can find that on goldenjackass.com. Thank you for joining us today on usawatchdog.com.
My pleasure.